$180. That is the gap. That is the spread between what gold costs in Dubai right now and what it closed at in New York on Friday. While you were sleeping, while American markets were dark, while Wall Street traders were at their beach houses, gold traded at $2,847 per ounce in the Dubai Gold Souk. New York's paper price closed Friday at $2,667. That is a 6.7% premium. That is not normal. That is not a rounding error. That is a screaming alarm that something is breaking in the global gold market. For decades, gold prices have been set by Western paper markets, the COMEX in New York, the LBMA in London, futures contracts and ETFs that trade billions of dollars worth of gold that mostly does not exist. But this weekend, the physical market diverged. Real buyers with real money paying for real metal decided that the paper price was a lie, and they paid $180 more per ounce to get actual gold in their hands. This weekend gap is not just a curiosity for gold traders, it is a signal, a warning, a preview of what happens when the paper market loses control, when physical reality overwhelms financial fiction, when the East stops playing by Western rules. Let me show you exactly what happened, why it matters, and what it means for your money. To understand why a $180 gap is significant, you need to understand how the gold market actually works. Because it does not work the way most people think. It does not work the way a normal market should work. There are two gold markets operating simultaneously, the paper market and the physical market. They are supposed to track each other. They are supposed to be connected by arbitrage. When prices diverge, traders are supposed to buy in the cheap market and sell in the expensive market until the prices converge. That is how efficient markets work. The paper market is dominated by the COMEX in New York and the LBMA in London. These markets trade contracts that represent gold, futures, options, unallocated accounts. Most of this trading never results in physical delivery. Traders buy and sell paper claims, settle in cash, and never touch an ounce of actual metal. The daily trading volume on COMEX often exceeds the entire annual global gold production. It is a casino where the chips are labeled gold, but the gold itself rarely moves. The physical market is different. In Dubai, in Shanghai, in Mumbai, in Singapore, when someone buys gold, they take delivery. They walk out with metal. The Dubai Gold Souk is the largest physical gold market in the world. Over 300 retailers in a single district, billions of dollars in inventory. When you buy gold in Dubai, you are buying actual metal, not a promise, not a contract, gold. In a functioning market, the paper price and the physical price should be nearly identical. Maybe a few dollars difference for transaction costs and logistics, but $180. That is not a transaction cost. That is a market fracture. The weekend gap exists because Western paper markets close on Friday afternoon and do not reopen until Sunday evening. During that window, the physical markets in the Middle East and Asia continue trading. And this weekend, those markets told a very different story than the paper price suggested. Buyers in Dubai were willing to pay $2,147 for gold. Not because they are foolish, because they believe the paper price is wrong, because they believe the Western price is artificially suppressed, because they want metal in hand before something breaks. Let me walk you through exactly what happened this weekend, because the details reveal the depth of what is unfolding. Friday, 1:30 p.m. Eastern Time, COMEX gold futures close at $2,767. That is the official Western price. That is the number that gets reported on CNBC. That is what your portfolio statement shows if you own GLD or any other paper gold product. Friday evening, Dubai time. Trading continues in the physical market. Gold opens at approximately $2,120. Already a $53 premium over the New York close. This is unusual, but not unprecedented. Weekend premiums of $20 to $40 have been common in recent months. Saturday morning, Dubai. Buying accelerates. Reports from dealers in the Gold Souk describe exceptional demand from Indian buyers ahead of wedding season. Exceptional demand from Chinese buyers routing purchases through Dubai to avoid domestic restrictions. Exceptional demand from wealthy Middle Eastern families diversifying out of dollars. Saturday afternoon, Dubai. The premium expands. Gold trades at $2,780, then $2,800. Dealers report that 1 kilo bars are selling out. Inventory is being replenished from vault stocks that were meant for next week. Sunday, Dubai. The peak. Gold hits $2,147 in active trading, a full $180 above the New York close. Premiums on smaller bars and coins are even higher. 1-ounce coins trade at the equivalent of $2,900 due to scarcity. I spoke to a contact who works with a bullion dealer in Dubai. He described the weekend as panic buying. His word, panic. Buyers were not negotiating. They were not shopping around. They were paying asking price and taking whatever was available. He said he has not seen demand like this since the COVID crash in March 2020. Now here is what makes this significant. Dubai is not an isolated market. It is a hub that connects East and West. Wealthy buyers from India, Pakistan, China, Russia, Iran, and Africa all use Dubai as their physical gold marketplace. When Dubai premiums spike, it reflects demand across the entire Eastern Hemisphere. The Shanghai Gold Exchange was closed for a holiday this weekend. When it reopens, it will likely show similar premiums. The Hong Kong market will reflect the same demand. Singapore will show the same pattern. The entire physical gold market in the East is repricing higher than Western paper markets. This is not speculation. This is observable reality. So why is the physical market diverging from the paper market? Why are Eastern buyers willing to pay $180 more than the official price? There are 5 factors converging simultaneously. Factor 1. Distrust of the Western financial system. Since 2022, when America froze $300 billion in Russian central bank reserves, wealthy individuals and institutions in non-Western countries have been asking a simple question. If they can do it to Russia, can they do it to us? The answer is yes. America can freeze any dollar-denominated assets it wants. It can exclude anyone from the SWIFT payment network. It can sanction banks, individuals, and entire countries. And there is no appeal, no court, no due process. Just a Treasury Department decision. Physical gold in your own possession cannot be frozen. It cannot be sanctioned. It cannot be turned off remotely. Wealthy buyers in the Middle East, Asia, and Africa understand this. They are converting paper claims into physical metal as fast as they can. And this weekend, that demand exceeded supply. Factor 2. Central bank buying continues at record pace. The People's Bank of China has been buying gold for over 30 consecutive months. The Reserve Bank of India has accelerated purchases. Central banks in Poland, Turkey, Singapore, and throughout the Middle East are all adding to reserves. This central bank demand does not show up in COMEX. They are not buying futures contracts. They are buying physical metal, often through off-market transactions that bypass Western exchanges entirely. They are draining physical supply while paper traders remain oblivious. Factor 3. Indian wedding season demand. This might sound trivial, but it is not. India is the second largest gold market in the world. Wedding season, which runs from November through February, accounts for a massive surge in gold demand. Indian families buy gold for dowries, for gifts, for investment. And this year, the wedding season is coinciding with festivals that further boost demand. Indian buyers often route purchases through Dubai because prices are lower than domestic Indian markets due to import duties. This weekend, that demand collided with already tight supply. Factor 4. Chinese New Year preparation. The year of the snake begins in late January. Chinese culture associates gold with prosperity and luck. Demand for gold gifts spikes in the weeks before the new year. And this year, with the Chinese economy struggling and the yuan under pressure, gold demand is particularly intense. Chinese buyers face restrictions on how much gold they can purchase domestically. They use Dubai, Singapore, and Hong Kong as alternatives. This weekend's premium reflects that demand pressure. Factor 5. Anticipation of a paper market event. This is the factor that most concerns me. Sophisticated buyers, the kind who move markets, often have information before the public. They hear rumors, they see data, they sense stress in the system before it becomes obvious. The $180 premium suggests that some large buyers believe something is about to happen in Western paper markets. Maybe a bank failure, maybe a COMEX delivery problem, maybe a major fraud exposure, maybe a geopolitical shock. They do not know exactly what, but they want physical metal before it happens, and they are willing to pay a steep premium for that insurance. This is not the first time we have seen weekend gaps and physical premiums spike. History shows us what typically follows. March 2020, the COVID crash. As Western markets collapsed, paper gold prices fell along with everything else. But physical premiums exploded. Dealers were charging $100, $150, $200 over spot for coins and small bars. Many dealers simply had no inventory at any price. The paper market said gold was $2,500. The physical market said try $1,700 if you can find it. What happened next? Over the following 6 months, gold rallied from $1,500 to over $2,000, a 33% gain. The physical market correctly predicted where the paper price was headed. September 2022. After the Russia sanctions and the UK pension crisis, physical premiums in Dubai and Singapore spiked to $50, $80 over London prices. Central banks accelerated buying. What happened next? Gold rallied from $1,050 to $2,000 over the following year. A 21% gain, January 2016. During the China currency devaluation fear, Shanghai premiums exceeded $30 over Western prices. What happened next? Gold bottomed within weeks and rallied 30% over the following 8 months. The pattern is consistent. When physical premiums spike, when Eastern buyers pay significant amounts above paper prices, it signals that the paper price is wrong, not the physical price, the paper price. The physical market leads, the paper market follows. Sometimes it takes days, sometimes weeks, but the paper price eventually rises to meet physical reality. Or, in extreme scenarios, the paper market breaks entirely and becomes irrelevant. This weekend's $180 premium is the largest I have tracked since March 2020. It is telling us something important. The paper gold market is mispricing the metal, and a correction is coming. Now let me explain why this matters for you personally. Even if you do not trade gold, even if you do not own any gold, this weekend gap affects everyone. First, the gold price is a signal about currencies. Gold is priced in dollars. When gold rises, it means the dollar is losing value relative to real assets. The $180 premium in Dubai is telling you that Eastern markets believe the dollar is weaker than Western markets admit. They are willing to pay more in dollar terms because they believe dollars will be worth less soon. If they are right, everything priced in dollars becomes more expensive. Your groceries, your gas, your rent. The gold premium is an early warning of inflation that has not yet shown up in official statistics. Second, the gap reveals manipulation in Western markets. The paper gold market has been suppressed for years. Big banks hold massive short positions. They use algorithms to smash the price whenever it threatens to break out. They dump paper contracts to create artificial supply. The weekend gap happens because the manipulators are asleep. When Western markets close, the suppression stops. The physical market trades freely, and the price rises to its natural level. The $180 gap is a measure of how much artificial suppression exists in normal trading hours. If you own paper gold, if you own GLD or other ETFs, you own a product whose price is being manipulated downward. You are being cheated. The real value of your gold is higher than what your brokerage statement shows. Third, the gap signals potential delivery problems. When physical premiums spike, it often means that physical supply is tight. Buyers are paying more because metal is scarce. If this continues, if premiums stay elevated, it suggests that the COMEX and LBMA may not have enough metal to meet delivery demands. We have discussed COMEX inventory problems before on this channel. Registered gold is near multi-year lows. If enough buyers stand for delivery, the exchange cannot meet its obligations. A $180 weekend premium is a warning that we may be approaching that breaking point. Fourth, this is wealth transfer in real time. The wealthy families in Dubai paying $2,847 per ounce understand something that most Americans do not. They are trading paper currency for real assets. They are exiting a system they do not trust. They are positioning for a world where physical ownership matters more than electronic claims. Every ounce they buy is an ounce that will not be available to you later. When the paper market breaks, when everyone suddenly wants physical gold, there will not be enough. The premium will not be $180. It will be $500. Or there will be no gold available at any price. The wealth transfer is happening now, from west to east, from paper holders to physical holders, from the unaware to the prepared. Which side are you on? So, what do you do with this information? How do you act on a weekend gap that most people will never hear about? Step 1. Understand that paper gold is not gold. If you own GLD, IAU, or other ETFs, you own shares in a trust that claims to hold gold. You do not own gold. In a crisis, the trust can settle in cash. They can halt redemptions. They can change the rules. You have counterparty risk to the fund manager, the custodian, and the entire financial system. The weekend gap exists because paper is not physical. Paper trades in New York, physical trades in Dubai. And this weekend, physical commanded a 7% premium. That premium is the cost of counterparty risk. It is the price of trust. And buyers in Dubai are saying they do not trust the paper system. Step 2. Acquire physical metal while you still can. The window is closing. Every week, more metal flows from west to east. Every week, COMEX inventories decline. Every week, the premium for physical over paper expands. Here is how to approach this based on your resources. If you have $500, buy gold fractionals or silver, a quarter-ounce gold coin or 15 ounces of silver. This is your starter position, your insurance policy, real metal in your hands. If you have $5,000, buy 1 ounce of gold and 50 to 100 ounces of silver. Diversify between the two metals. Keep them in a secure location at home or in a private vault. If you have $25,000, buy 5 to 7 ounces of gold and 200 ounces of silver. Consider splitting storage between home and a private vault. Do not store everything in one location. If you have $100,000 or more, allocate 15% to 25% to physical precious metals. Consider international storage in Singapore or Switzerland. Consider allocated, segregated storage where your specific bars are identified and held in your name. Step 3. Buy from reputable dealers who have inventory. The weekend gap also appeared in dealer premiums across America. APMEX, JM Bullion, SD Bullion all showed elevated premiums this weekend. Some products were out of stock entirely. When you buy, check that the dealer actually has the metal. Avoid long delivery times, avoid pre-orders. You want metal that ships within 1 to 3 business days. If a dealer is quoting 6-week delivery, they do not have the metal. They are hoping to source it after you pay. Step 4. Consider the Monday open carefully. When COMEX opens Sunday evening, the paper price will react to the weekend gap. There are 2 possibilities. Possibility 1. The paper price gaps up toward physical reality. This would be bullish. It would confirm that the market recognizes the shortage. It would mean your physical metal just became more valuable. Possibility 2. The paper price stays flat or drops. The manipulators would be fighting the physical market. This would create an even larger divergence. It would be bearish for paper gold holders, but bullish for physical gold holders because it would confirm the manipulation and extend the buying opportunity. Either way, owning physical metal is the right position. You win if the paper price rises to meet physical. You win if the paper price stays suppressed because you can buy more metal cheaply while the divergence continues. Step 5. Watch for the gap to close or not. In a healthy market, the gap should close when New York reopens. Arbitrageurs should buy cheap paper gold and sell expensive physical, collapsing the premium back towards zero. If the gap does not close, if premiums stay elevated, that is a major warning sign. It means the arbitrage is not possible. It means there is not enough physical metal to flow from where it is cheap to where it is expensive. It means the paper market is disconnecting from reality. I will be tracking the Monday open closely and will post an update on the community tab if something significant happens. A $180 weekend gap is not noise. It is not a quirk, it is the physical market telling you what the paper market is hiding. Eastern buyers know something. They are paying premium prices for real metal, and they are not stopping. But the gold gap is just one piece of a larger puzzle. There is a specific chart that tracks the relationship between paper gold and physical gold over time. It shows every major divergence in history. It predicted the 2020 rally. It predicted the 2022 rally, and right now, it is showing the widest divergence in 15 years. I break down that chart and what it means for gold prices in this video right here. Click it now. If you own any gold or if you are thinking about buying, this is essential information. I will see you there.